I'm Riti Samanta, Global Co-Head of Fixed Income at Russell Investments. This week, I'd like to focus on three major themes that are framing fixed income markets: the evolving policy backdrop, AI-related developments in corporate credit, and what we're seeing across securitized markets. Let's begin with the macro picture. The Federal Reserve left interest rates unchanged at last week's meeting, but what stood out wasn't the decision itself, it was the well-telegrammed and intentional lack of forward guidance. In the absence of clear direction from the Fed, the market has effectively spoken. Two-year Treasury yields have rallied back towards 4.2%, reflecting a shift in expectations. It's a notable change from the beginning of the year, when markets were pricing in around 2 rate cuts. Today, investors are increasingly contemplating a prolonged pause, and in some scenarios, even the possibility of another rate hike. Elsewhere, we've also seen growing attention on Japan, as policymakers have embarked on a concerted effort for rate normalization. In a historical act of coordination this week, U.S. and Japanese policymakers jointly intervened in the yen market, with the U.S. Treasury supporting the yen through the sale of euro reserves. The yen responded by appreciating from levels of 165 to closer to 155 through the period, and public comments from Treasury Secretary Scott Bessent suggested the yen remains undervalued, which have also helped support the currency and set the stage for a U.S. Treasury that is willing to be more activist in nature. Meanwhile, bond market volatility has edged higher over the past month. The MOVE index, which measures implied bond market volatility, has risen as investors continue to navigate both policy uncertainty and ongoing geopolitical risks. Economic data, meanwhile, has remained surprisingly resilient. The ISM Manufacturing Index rose to 55.6 in July, its highest level since May of 2022, and well above expectations. The underlying details were equally encouraging, with gains in new orders, backlogs, and production pointing to continued momentum in the manufacturing sector. The labor market also continues to show signs of gradual rebalancing rather than sharp weakness. Job openings fell to just under 7.4 million, while the ratio of openings to unemployed workers edged slightly up to 1.03 from 1.04. Companies have reported earnings growth of over 20% quarter on quarter, and 88% of those companies have been beating consensus earnings estimates. The stock market has had a particularly strong rally this month, gaining 3% already in the month of August, as investors have once again re-engaged with the AI trade. Taken together, the data across labor, manufacturing, and the corporate sector is consistent with an economy that continues to expand without showing signs of overheating. Turning now specifically to corporate credit, one of the defining narratives this year has been the extraordinary wave of AI-related issuance. Through the first half of 2026, AI-related borrowers accounted for roughly $220 billion of investment-grade issuance, which made up about 18% of the total supply and already exceeded the full-year total from 2025. While that level of issuance has been impressive, it has also created greater differentiation across the market. AI issuers have generally traded at wider spreads than the broader investment-grade universe, reflecting the sheer volume of new supply. Companies such as Oracle and SpaceX, particularly those that have issued later in the quarter, have seen spreads widen following issuance as investors have sought to absorb this extra supply. Despite this, the broader corporate credit backdrop remains healthy. All-in investment-grade yields continue to sit around 5.3%, providing an attractive level of income for investors. Corporate fundamentals also remain supportive, with leverage close to historical lows and ratings upgrades continuing to outpace downgrades. Another important feature of this issuance wave is its impact on the market structure. Around 70% of AI-related issuance has been concentrated in maturities beyond 6 years, with more than a third being issued beyond 18 years. That is reshaping the long end of the investment-grade credit market and creating opportunities across adjacent sectors, including securitized assets linked to data centers and other AI-related infrastructure. Within our portfolios, we've selectively increased exposure to high-quality data centers and single-asset, single-borrower, or SASB securities. We continue to differentiate between areas of AI investment, favoring segments where we believe long-term fundamentals remain strongest and the risk of obsolescence with the rapid technological advance is relatively contained. Finally, turning to securitized credit more broadly, we continue to hold a constructive view on this asset class. One reason for this is that securitized assets benefit from floating rate structures, which continue to have some insulation in an environment where inflation remains elevated and policy uncertainty persists. That said, we're also watching evidence of a more K-shaped economy, something we've touched on in previous sessions. Credit performance is increasingly diverging across borrower groups. Delinquencies continue to rise among lower quality borrowers, particularly within Ginnie Mae mortgages and subprime auto ABS, while prime borrowers have generally remained resilient. This divergence reinforces the importance of active security selection as conditions become more differentiated across sectors. Overall, while markets continue to navigate policy uncertainty and elevated volatility, we believe fixed income remains well positioned to deliver attractive income opportunities. A disciplined and selective approach across government bonds, investment-grade credit, and securitized assets continue to offer compelling value in today's environment. Thank you for watching, and please join my colleague next week at the Market Week in Review.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.